Are you an investor looking to diversify your portfolio with a promising real estate stock? Or perhaps you're curious about the potential risks and rewards of investing in Singapore's property market? Well, buckle up, because in this video, we're going to dive deep into the world of City Developments Limited, better known as CDL. This real estate behemoth has been making waves with its ambitious global expansion plans, snapping up prime properties across Europe and beyond. But with great ambition comes great risk, and CDL's growing debt levels have raised eyebrows among analysts and investors alike. So, should you take the plunge and add CDL to your portfolio, or is it a risky bet that's better left untouched? That's precisely what we'll uncover in this comprehensive analysis. We'll peel back the layers of CDL's financials, dissect its growth strategies, and weigh the pros and cons of investing in this Singaporean property powerhouse. CDL is a leading global real estate operating company with a vast network spanning over 100 locations across 29 countries and regions worldwide. Their diverse business encompasses a wide range of real estate sectors, including residential properties, commercial offices, hotels, service departments, retail malls, and integrated developments that combine various components into a single complex. As a prominent company listed on the Singapore Exchange, CDL holds a significant position as a major component of the Straits Times Index, which is the benchmark index for the Singapore stock market. With a proven track record spanning over 60 years in real estate development, investment, and management, CDL has developed more than 50,000 homes and owns around 23 million square feet of gross floor area dedicated to residential properties for lease, commercial spaces, and hospitality assets globally. In addition to its core real estate operations, CDL also has a strong presence in the hospitality industry through its wholly owned subsidiary, Millennium and AMP, Copthorne Hotels Limited, M&AMP, C. Together, the group boasts over 155 hotels across key gateway cities worldwide, further diversifying its income streams and expanding its global footprint. CDL's geographically diverse portfolio and income-stable assets contribute to the company's resilience and long-term sustainable growth. City Developments Limited, CDL, one of Singapore's largest property developers, has seen its stock price underperform the broader market in recent times. Year-to-date, CDL's shares have declined by around 15%, in contrast to the Straits Times Index, STI, which has risen by approximately 3% during the same period. This underperformance has drawn the attention of analysts who closely monitor the company's performance. Analysts have cited several factors contributing to CDL's lackluster stock performance. One major concern is the company's rising debt levels, which have increased due to an acquisition spree over the past few years. Higher debt translates to higher interest costs, ultimately eating into the company's profits and impacting its bottom line. Additionally, CDL's return on equity, ROE, a key measure of profitability, has been relatively low, further fueling investor concerns. However, it's not all gloomy for CDL. The company's management remains focused on growth and has been actively expanding its global footprint. Recently, CDL acquired the Hilton Paris Opera Hotel for around $350 million and a co-living project in the UK for $149 million. These investments are aimed at capitalizing on the anticipated hospitality recovery in Europe, particularly ahead of the 2024 Paris Olympics. Nonetheless, these acquisitions will also contribute to CDL's debt burden in the near term. RHB Bank's analyst Vijay Natarajan has maintained a buy rating on City Developments Limited, CDL, one of Singapore's largest property developers. However, he has lowered his target price for the company's shares from $8 to $7.30 per share. This decision comes after CDL's stock price underperformed the broader market recently, with the shares down around 15% year-to-date compared to just a 3% rise in the Straits Times Index. Despite the lowered target price, Natarajan believes that CDL's planned divestments of around $1 billion worth of assets this year could provide a positive catalyst for the stock. The analyst's view is that these divestments, which are part of CDL's strategy to streamline its portfolio and focus on core markets, could help unlock value for shareholders. CDL has been actively expanding its presence in overseas markets, particularly in Europe. In May, the company acquired the 268-room Hilton Paris Opera Hotel for around $350 million, and in April, it acquired the Yard House project in the UK for around $149 million, which will be developed into co-living studios. These acquisitions are part of CDL's growth plans, as the company aims to capitalize on the recovery in the hospitality sector and the growing demand for co-living spaces. One of the key factors investors are closely monitoring with City Developments Limited, CDL, is the company's rising debt levels. Over the past few years, CDL has been on an acquisition spree, acquiring properties and businesses across various markets. While this expansion strategy can drive future growth, it also means taking on more debt to fund these purchases. Higher debt levels translate to higher interest costs, which can eat into the company's profits and impact its bottom line. Another major concern for investors is CDL's low return on equity, ROE, a crucial metric that measures a company's profitability by comparing its net income to the shareholders' equity. An ROE below 10% is generally considered poor performance, indicating that the company is not efficiently utilizing the equity capital invested by its shareholders to generate profits. A low ROE can be a red flag for investors, as it suggests that the company may be struggling to generate adequate returns on the money invested by its shareholders, potentially impacting its overall financial health and future growth prospects. CDL's management remains focused on expanding the company's global footprint and driving growth, despite the challenges posed by the current economic climate. In line with this strategy, they recently made two significant acquisitions in Europe: the prestigious Hilton Paris Opera Hotel for around $350 million and a co-living project in the UK for approximately $149 million. These strategic investments position CDL to capitalize on the anticipated surge in tourism and hospitality demand leading up to the highly anticipated 2024 Paris Olympics. With the Hilton Paris Opera Hotel acquisition, CDL now operates 3 hotels with a total of 670 rooms in the French capital, strengthening its presence in this key European market ahead of the Olympic Games. While these acquisitions are expected to bolster CDL's recurring income streams and provide potential for value enhancement, they will also contribute to an increase in the company's debt levels in the near term. However, CDL is betting that the post-pandemic recovery in the European hospitality sector, coupled with the influx of visitors during the 2024 Olympics, will drive substantial revenue growth and justify these investments. From a valuation perspective, CDL's current stock price values the company at around 14 times its expected earnings for the next year. This price-to-earnings, or P/E ratio of 14, is roughly in line with CDL's historical average valuation over the past few years. In addition to the earnings multiple, the stock also offers investors an attractive dividend yield above 2%. This means that for every $100 invested in CDL shares, you can expect to receive over $2 in annual dividend payments. While CDL's valuation doesn't appear overly expensive based on these metrics, the company is facing some near-term challenges from its rising debt levels. As CDL has been on an acquisition spree, taking over properties like the Hilton Paris Opera Hotel, its debt burden has increased substantially. Higher debt means higher interest costs that eat into profits. This debt headwind could weigh on CDL's earnings and stock price in the short run. However, the company's management team has a clear strategy to tackle the debt issue. They plan to divest or sell off around $1 billion worth of assets and properties this year. Unlocking this value from their existing portfolio would provide CDL with cash proceeds to pay down debt. Additionally, CDL has a diversified global footprint spanning residential, commercial, hospitality, and integrated developments across 29 countries. This geographic and product diversity could help insulate the company from any localized real estate downturns. So in summary, while rising debt is a near-term concern for CDL, the company's attractive valuation metrics, shareholder-friendly dividend policy, planned divestments, and diversified property portfolio could provide some upside potential for long-term investors willing to look past the short-term headwinds. As always, investors should do their own research, but CDL seems to offer an intriguing risk-reward proposition at current levels. So in summary, CDL is facing some near-term headwinds from rising debt costs. But their diversified global property portfolio and focus on unlocking value through divestments could provide upside potential. As always, do your own research before buying or selling any stock. Let me know in the comments below if you'd invest in CDL at these levels or if you prefer other Singapore property plays, and if you found this video useful, hit that like button. It really helps out the channel. While you're at it, subscribe and hit the notification bell so you never miss my latest investing insights and stock analysis videos. Thanks for watching, investors. This has been Iggy from the Investing Iguana. Until next time.